Hello and good morning, listeners. This is Almus Market Mornings, your daily dose of global financial update with Shikhar Garg. And folks, we have had the US inflation data releasing yesterday, and it didn't do much for the ongoing banking concerns out there. The core inflation was stronger than expected in the month of Feb, even though on year basis it edged down a little. Now, this can continue to push the concerns of aggressive rate hikes, but considering the banking saga, there is a mixed expectations on the rate front. 76% expectations of a 25 basis hike in the next FOMC still continues. But what we are also observing is oil prices coming down. In the past 2 days, oil has come down quite significantly, and the volatility on the bond side has continued to stay quite high. So, JK, I'd like your inputs on these fronts. Like, even though oil is coming down on the growth concerns and inflation staying strong, what do you think would be the course of action ahead in the financial markets?
Good morning. So a lot happening, although yesterday relative calm descended on the markets with measures taken by the Fed and also President Biden issuing a statement saying banking system is safe and vowed to impose stiffer banking regulations. Now the banking shares actually bounced yesterday, quite well, with the sentiment improving. But the million-dollar question is how long will it sustain? And now that the core weakness in the banking system has been sparked off. Also, somewhat comforting was, as you said, the US annual inflation that fell to 6%, which was, of course, expected. But the month-on-month core rate was slightly higher. So, which means that the core inflation is remaining sticky as it has been in most of the economies. The house rentals and the food price inflations are continuing to bother the central banks, which is contributing to the core inflation being higher. So now a lot of things can hinge on what the Fed does in the coming days, and also the upcoming data. We have retail sales today, which is an indicator of the consumption level. And one would say that with the current crisis on, and the liquidity crunch, etc., and the depositors getting cautious about the banking systems, we might actually see a moderation or even a fall in the consumer spending, and maybe unemployment going up. In fact, yesterday, Meta Group announced a fresh job cuts of 11,000 employees. That is the second round of job cuts that have been, they have announced. While Meta shares rallied because company is going to incur less expenses. It's for the economy. It is somewhat sobering news. Although inwardly, Fed might be happy that this also contributes to lower demand and possibly lower inflation going forward. Now, as someone put it succinctly, Fed is going to have to pick its poison, tolerate some inflation for a bit to see if its current series of rate hike takes hold, and pause, or keep hiking and deal with financial instability caused by their own policy decision. It's really a toss-up, which way they're going to choose, and maybe the upcoming data will also help. And we still have, other outside, or rather the other side of Atlantic, we have events coming up today. We have UK budget that will be presented, and the British Finance Minister Jeremy Hunt said he would use this week's budget plan to remove the barriers, including high childcare costs that are stopping people from working. They have had a surplus in the budget in the last 1 or 2 months, and that has given some leeway for him to increase spending, or even give some tax cuts, which they have been clamoring for. But really, the jobless rate that UK has been seeing has been steady, while the wage inflation has moderated as per data released yesterday. That should give some more comfort to the government. Then we have the ECB coming up tomorrow. Now, ECB officials have given a statement saying that their system is much stronger to withstand any fallout of the failure of banks in the US. And in fact, Moody's also said some comforting words, saying that unlike the US banks, European banks are unlikely to find themselves compelled to liquidate their bond holdings at a loss. So that actually contrasts with their statement, or rather, they're downgrading the entire banking sector in the US from stable to negative. So no wonder Euro is holding on to its gains and not really finding too much of dent on its strength so far post the events of weekend. Now, stocks gained some composure after CPI came lower than expected, or rather lower as expected, and the financial stocks bounced. Investors taking comfort from the Fed moves and the president's statements. Many banks who were sold off earlier bounced back strongly. Also improving the sentiment was data from China, where industrial production and retail sales were strong as expected. The fear factor in the market was subsiding was also evident from the fact that yields across maturities bounced from their deep slump seen previous day. The 2-year yield bouncing to 4.39 from a low of 3.83, 10-year from a low of 3.46 to 3.69. German benchmark yield, 10-year yield rose from a low of 2.18 to 2.46, erasing almost all of its previous days' losses. Now, a more balanced view of Fed is, as you said, 75% favoring at 0.25 basis hike in the rate, and possibly looking out to pause after this if the data comforts them with the lower inflation and consumption demand coming down in the US. Futures are pricing in 2 rate cuts by the year end, with the terminal rate seen now at 4.179 by December, down from 5% last week. There's a massive drop there. Now, coming to India, even as the world was coming to terms with the fresh banking crisis and its fallout of the broader markets, Indian market has seen its own mini meltdown in the last 2 sessions. Equities were down heavily, with major indices losing nearly 4%, led by banking shares. Rupee, which surprisingly opened stronger on Monday, even after the SVB bank was closed over the weekend, then made a huge turnaround with a steady demand from importers, oil companies, and then the traders also joining with the trend. And central bank did not make much of an appearance until it hit the level of 82.50. Essentially, the lower levels below 82 is still attracting very good demand. And the risk-off sentiment that was in the market only added to the demand for the dollars. But again, with the CPI number coming lower in the US and also the sentiment improving, we are already observing some improvement in the Indian financial markets. Early indications that stocks will be higher today, probably due to short covering. And rupee is also boosted, probably showing around 82.30 or lower, as oil price has fallen by almost 4% overnight. And so oil continues to help the Indian macros. We will have more evidence whether it is really reflecting as a lower deficit for second consecutive months, as the data is scheduled today without a specific time being mentioned. Finally, the wholesale price in inflation in India also again fell yesterday at 3.85, a level last seen in January 2021, when it was at 2.51. However, the massive drop in WPI does not have a policy implication, as it is not comprehensive like the consumer price index. It does not capture the prices of services which CPI does. And in WPI, more weightage is given to manufactured goods, while CPI, more weightage is given to food items. But I think as far as RBI is concerned, the core inflation, which has been sticky around 6%, should be of more concern. I think, notwithstanding what Fed does and how the situation evolves in the global market, we still favor a 0.25% hike in RBI's policy rate when they meet in first week of April. Thank you.
Okay, JK, that's quite good. And yes, folks, although the Indian equity market saw some sort of a beating in the past 2 days, as JK mentioned, there can be some possibility with the low inflation in the US and expected pause after this one rate hike cycle. Uh, we can see some sort of short covering from the traders in the market. But yes, the WPI number was quite interestingly on the lower side. And although the trade balance is yet to be released, it is going to be one key factor to be observed when it comes to direction for the USD INR as a currency pair. Weak oil is already supporting it, but it is still the overall trade deficit that the country is having will you know give us cues on what sort of demand does exist for the currencies across the channels. But what's also interesting is to be seen is the retail sales number, which can give us cues on the consumption of the US economy and further ideas about whether the Fed is going to go around with a pause after this particular hike, or they may still need some more hikes, as the jobs market, although are in a mixed space, but continues to see some sort of concerning news, just like Meta giving job cuts. So that's that for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.